Hello, everyone, and welcome to Not Just Numbers, Honest Conversations with a Financial Advisor and Lawyer. I am Madison Demora, and I'm here with Mike Gary. Mike is a financial advisor and a CFP practitioner and the founder and the CEO of Yardley Wealth Management. He is also an estate planning lawyer, and his law firm is Yardley Estate Planning. Hey, Mike.
Hey, Maddie, how are you?
I'm good. How are you?
Good. You ready to get these podcasts kicked off for 2026? We had a little
Yep,
bit of a
I'm
hiatus
ready.
here. Yeah.
Yes. All right. So, Mike and I had a long discussion off mic about what we wanted today's episode to be. And honestly, the conversation itself was so good that we decided let's bring it into the podcast. So, today we're covering three big things: why ongoing financial advice matters way more than people think, the tax mistakes people make, even smart people, that cost them thousands, and then a deep dive into what's happening in the planning industry, from independent advisors to private equity to something called the Great Stall. Lots to unpack, so let's get right into it. Mike, let's start with a question that comes up constantly. Why do I need ongoing planning? Can I just come in once, get a plan, pay a small fee, and just be done?
Maddie, it's a totally fair question. We are fee only and our pricing is on the website. So people can see if they have a significant amount of investments that their ongoing fee is going to be pretty big. It will be in the thousands or tens of thousands of dollars. Since they have never worked with us or maybe have never worked with any other advisor either, it's hard for them to know what value we might bring. Prospective clients can multiply the value of their investments by our fee schedule and know what the cost will be. In the media and on socials, it's only ever shown as a cost to avoid. There's rarely mention of what you might get for that fee and why it might be totally worth it. I saw a post like that just yesterday. The media and socials also don't really know how labor intensive planning can be. It's not like 25 years ago where most advisors just manage money. For clients who are looking for it and want it, there can be a fair amount of planning that go into most relationships. Meanwhile, most advisors aren't fee only and don't always have to act as fiduciaries and don't put their fees or commissions on their websites, so their costs can be quite murky. There are plenty of advisors who sell products with big commissions that the client will probably never see, so the client can pay 6% on an annuity with big ongoing costs in a product that they're locked into, or upwards of 10% on non-traded REITs or private market investments that they can't get out of. Those two types of products don't usually come with much financial planning, but they do come with a lot of expenses and other issues. To recap, a one-time review gives you information that you have to act on and then make updates on your own. And some people can do that. I've found that most people can't. Ongoing advice gives you execution, monitoring, and results. At our firm, we don't just build the plan, we put it into motion. We manage your investments, we adjust strategies as your life changes and market shifts, and as the tax laws change. And tax laws, they change a lot.
Right. And the people who really benefit are high earners or people with significant assets, anyone who has enough to leave behind to beneficiaries and charities.
Exactly. And tax efficiency is not something you solve once. It's a year by year process, especially since the rules change basically every year. Things you have to think about on a yearly basis for most people are when to realize gains or losses, if and when to do Roth conversions, whether to take Social Security now or delay, how to structure tax efficient withdrawals, how to work with CPA so you have tax planning, not just tax compliance, where in your accounts to place different investment types and when to rebalance them, and making sure your entire plan aligns with your goals. These aren't one-time decisions. They require ongoing attention. Goals and situations change. Done right, they can save people way more than they pay in advisory fees and provide a lot of peace of mind.
That's right. All right, Mike, let's get into some real examples. You pointed out that people who retire with both taxable money and sizable IRAs sometimes choose the withdrawal order that hurts them the most.
Right. Here's a very common mistake. Sometimes retirees with enough cash savings to live on for a year or two or more, they think, great, I'll use my savings first and avoid paying taxes. And yes, they might pay almost no taxes that year, but that's not necessarily a good thing.
This part surprised me because most people would think zero taxes equals good.
Exactly. But the tax code literally includes 0% buckets for income and capital gains, If you don't intentionally fill those buckets while you can, you're essentially volunteering to pay higher taxes later. For example, a married couple can have over $100,000 of income and still pay no tax because of the standard deduction and the bracket structure. If you skip that opportunity, the IRS doesn't give it back later or give you a do-over.
So spending from savings first isn't always the smartest move.
Right. It can be far better for some people, and everybody's situation is a little bit different, right? We have to be honest about that. Like how much they have in taxable versus tax deferred, and if they have any Roth, and how much they have in just plain old savings, right? But for some people, it's far better to pull some income from the IRA by doing Roth conversions and or intentionally realize taxable gains when you're in a very low tax bracket, like the zero. Otherwise later in life, you get hit hard when your required minimum distributions, Social Security, and any other income sources start piling up, and you have a bucket load of unrealized gains in your taxable account. So every time you need to take money out, you'll have a large relative amount of income, and it'll be taxed much harder than it could have been.
And then the Social Security timing mistake.
Yep. A lot of people take Social Security early because they think, well, what if I don't live that long? And that might be correct in some cases. We used to really advocate for people to delay until 70 to take Social Security, and we still do for most people, but not everyone. We do try to get people to delay at least a little because they don't realize that Social Security fills up those low tax brackets rapidly, which means there's less room for Roth conversions or tax efficient withdrawals. So again, these decisions are connected year by year. You can't just look at a single snapshot moment.
One thing you said when we were talking is that people really need to look at their tax return every year, not just what happened last year, but what the next few years will look like. So, bottom line, the strategy can change each year.
Absolutely. Tax planning is a lifetime exercise, not a 1 year one. A good withdrawal plan should focus on lowering your lifetime taxes, not just lowering this year's taxes. You have to consider what income you have this year, what income you expect next year, how Social Security, pensions, or required minimum distributions will change things, and where your savings and investments are located. Making the wrong withdrawal decisions today can create much higher taxes for decades. Please let me be clear about something. I'm not advocating that the tax tail wag the investment dog, so to speak. We take taxes into consideration because they are very important, but we are mostly concerned about the overall plan, not just reducing taxes.
All right, Mike, let's shift into the industry talk. You recently read the Bob Vera's book, Behind the Scenes: My 45-Year Journey as an Insider in Financial Planning, and you mentioned something called the Great Stall in the financial planning world.
Yes, great book. Great, great book. And I'll have to reread it because there was so much in there. As for the great stall, as Bob called it, for a long time, brokers were leaving wirehouse firms like Merrill Lynch, Smith Barney, Payne Weber, and moving to independent fiduciary RIA firms. I did this myself in 2001 when I went to work for my old boss, Ram. But then something changed. Instead of becoming fully independent fiduciaries, many advisors moved to independent broker dealers like LPL or Edward Jones. They sound independent and they can act as fiduciaries sometimes, but they still operate under commission structures and don't have full fiduciary obligations. It's a partial step, not the real thing.
So the industry was moving towards independence and then kind of froze halfway. The spirit of true independence kind of got diluted.
Exactly. That's why Virez calls it a stall. Look, I get why if you're an advisor who sees their job as a sales job and their goal is to maximize their income in life while more or less doing right by the client, why they might think going to an independent broker dealer might feel like independence. And I also know that I was lucky. When I left Merrill to work for my last boss in 2001, I didn't know what fee only or fiduciary was. So it wasn't an active choice on my part. It's great when things work out in your life that weren't active choices. I do know that I wanted to stop working for Wall Street firms because every day in the Wall Street Journal, I'd see one of the Wall Street firms settling with a client or a regulator over something somebody did to a client. And somehow they were allowed to do that without ever admitting fault. I wrote about that in my first book, but my editor advised me to take out like over 100 pages I'd written about those scandals because she thought it would be too much for the reader and dilute my message. Being fully independent also comes with other costs and challenges, like deciding everything about the business you want to run and then paying for it. For those making the move from the wirehouses and seeing that, and also realizing they weren't going to get the occasional or regular huge commission check, it's probably a bridge too far. It's a shame because it's a way better way to live and work every day. And I think it's much better for clients. Look, well, I often need to convince clients of a course of action that they may not like to hear, like staying invested in a plunging stock market or saving more. They aren't sitting there wonder what I'm going to try to sell them. And I'm not thinking about selling them anything either. We're just having a conversation about what they need to do to protect their interests. I love it.
And then there's the private equity stuff, which I know you get bombarded with daily.
Every day. Emails, calls, LinkedIn messages, nonstop. In my industry, there's a lot of talk about the fact that a lot of advisory firms aren't growing anymore. And I think the reason why is that advisors are spending all their time trying to get other advisors to be bought up by the same firm that bought them. The reason I get bombarded by these messages is simple. Private equity firms can make a lot of money buying advisory firms. Why? Advisory firms are valued using a multiple of their annual earnings. When I sold a small amount of shares internally to Maureen and Karen, I received a much smaller multiple than I would have received by selling a firm owned by a private equity company. Private equity can afford to pay more because their firms are valued at higher multiples than financial advisory firms. So for them, it's like getting free money. I'm going to use rough, round, hypothetical numbers to illustrate my point. So let's say it makes sense based on our annual earnings for YWM to be valued at $5 million dollars for any normal financial advisor or COO purchaser like Maureen and Karen. A PE firm might offer me $7 million, dollars, way more than might make sense for another person, but they would do that because once the firm would be part of theirs, their whole thing becomes worth 10 million to them, right? It's free money for them. So I know why they're doing it.
And that's why they're so aggressive in outreach.
Exactly.
But what happens after they buy your firm?
Well, this is where things get messy. Back office jobs get consolidated, offices get merged, client service levels get pushed towards minimum viable. They want fewer meetings, fewer calls, fewer touches. Our team of seven would be cut to four or five. I've seen a lot of reports that advisors I could be more specific with that, right? They wouldn't need the three advisors that we have now, me, Maureen, and Amy, right? It could be two. And in our other operations staff, they might not need the COO that Karen is because people would be folded in somewhere else. They probably would let Janine go, right? And so it'd be Sandra working her butt off every day. And yeah, it would be terrible. And so, they have a very short term bottom line interest. And in terms of like what I said about like minimally viable, we when for our engaged clients, right? 80% of our clients engage with us pretty regularly, and we have them on schedules, and we email them, we call them, we talk to them, try to figure out how we can help them. Um, if this was run by a private equity company, the outgoing messages that we have to tell people to do things and or ask them to come into the office would just stop. So it would be Sandra and Maureen waiting for the phone to call, for the phone to ring, and then having to like follow up on the stuff requested by clients. And in like the short run, in like the first year or two, the private equity firm would make way more than me, Rachel, Maureen, and Karen would make from the firm this year, right? Because you have all those overhead costs are eliminated or reduced, and it would just be easier for them. They'd also consolidate a lot of technology because the technology they have, they wouldn't need all of our standalone technology. They would just use whatever else they have. So it would be way more profitable for them in the short run. But I think it would be awful for our clients. And, we'll be in business 20 years next month. And a lot of the clients that we have known a long time. And it really matters to me what happens to them. And so there's no way we're going to sell to a private equity company. The internal succession is harder, and figuring out the technology they have is harder. But, I'm not someone that gets FOMO and I don't need to make every dollar, right? Like, and I'm not saying like I'm a saint in any way. It's just a business decision. I get a chance to come into an office that I love, 3 days a week and work from home 2 days a week with a group here. Karen has assembled a great cast, and I feel lucky to be able to have the job that I have.
Yes. And woohoo to 20 years. That's awesome.
Yeah, it's pretty cool. February 10th, 2006 is when I left Rom.
Yeah. Um, Thank you to our clients to help us get to here too,
Yeah,
right?
yeah,
Thank you.
yeah. And
Um,
all of our wonderful employees.
yes. All right. So going back, that's why you choose to build an internal succession plan instead of selling.
Yeah, 100%. Our clients and our team deserve continuity and real relationships, not to be absorbed into a conglomerate. And don't cry for me that I'll make a little less. It's an active choice on my part, and I don't need to chase every nickel. I feel so fortunate that this has been the success it has been. And it was dicey. The first 10 years wasn't sure it was going to happen. But it's been good. I feel very fortunate. I love working every day and no plans to retire. You could ask Rachel. But we do need to plan for the future as I am not immortal, and planning should make things run more smoothly should something happen to me or I've decided it's time at some point.
All right. You also said you're concerned we might lose the independent ethos that makes fiduciary planning what it is.
Yeah, Bob, it's something I've seen, but Bob did a great job in his book, like laying it out. The first wave of independent advisors, mostly boomers, are retiring or selling to private equity. And the PE model is not built around independence, it's built around efficiency and profit. I'm afraid the profession could slide backward toward a more sales-driven structure, especially if the next generation doesn't continue the independent RIA movement. Firms these PE firms are building are very much like the wirehouse firms that boomers and I escaped 25 years ago.
Awesome, Mike. This was such an insightful conversation and a lot for people to think about. From tax strategy to industry trends, the message is basically this. Financial planning isn't one and done. It's ongoing, it's evolving, and it has real financial impact. Mike, thank you again for joining me.
Maddie, thank you so much for having this conversation and keeping me on track. I know that I could get in a little rant, and I did have a rant or two in this conversation. But this is a big part of my life, and I feel really strongly about these things. And I think it's good that other people know that. And I
Yeah.
hope any advisors who are listening to this will reconsider the independent broker dealer thing and go, full-fledged fiduciary RIA. It's the right way to do things, and I'm fortunate that I stumbled into it 25 years ago.
All right, so thank you all for listening. For more information on Yardley Wealth Management or Yardley Estate Planning, you can visit our websites at yardleywealth.net and yardleyestate.net. You can also follow us on socials at Yardley Wealth Management. Don't forget to subscribe to our YouTube channel. This podcast has been produced by Madison Demora and Mike Gary with technical and artistic help from Poe Productions.